Take one, interest rates. So with all this talk of these rapidly increasing interest rates, I bet you're wondering, how do these increasing interest rates affect your possible new house payment? Well, I'm going to break it down for you right now, so stay tuned. What's going on, everybody? I am Val Hardesty. I'm a local realtor here in the central Kentucky area and in the Elizabethtown and Bowling Green areas. Welcome to our channel, Central Kentucky Living. Well, let's get right into it, because I bet you're wondering, how exactly does a 6% or 6.5% interest rate affect my monthly payment on a house I'm getting ready to buy? Maybe you're in the market to purchase a new home and you're worried about what's going on with these rates. And we obviously know that in the last 2 years, they were extremely low, causing this buying frenzy and everyone to come out and purchase a home while rates were low. You could get a great house, more bang for your buck when rates were 2.5% than you can today when they're 6 and 6.5%. People in the last 2 years were refinancing like crazy and got some really good deals and a very low house payment. And now we're seeing, obviously, the hike in rates and people starting to fill up with a little bit of fear and anticipation and wondering, can I afford to buy a home? And what is the actual monthly difference between a 4.5% and maybe a 6.5%, and should I wait? Well, we're going to talk about it, and I'm going to break it down and what your house payment would look like if you're purchasing a $200,000, $300,000, $400,000, and $500,000 house right now in this 6.5% interest rate market that we're in. Now, do we think rates are going to go back down? Yes, of course we do, and they will. But currently, this is our situation. And is it flexible? And are you married to it forever? Yes, it's flexible, and no, you don't have to stay married forever. So in this video, we're just breaking this down in very basic terms. There are 3 things that obviously significantly affect what makes up your house payment. Those 3 things are monthly payment, of course, property taxes, and insurance. Now, your monthly payment, of course, is going to be determined by several different factors. And of course, you're going to be talking with your loan officer about these things, your lender, but it's going to basically break down to the type of loan you're using, the amount of money you're putting down, and whether or not you're going to have private mortgage insurance or not, also known as PMI. Your property taxes are going to fluctuate based on if you're purchasing a home within city, annex, or county areas. A good source to find out what those property taxes are is your local PBA website. And here's an example of ours in Warren County, and it breaks down what your property taxes are going to look like, and the only real difference is school district. Now, your homeowner's insurance is going to fluctuate based on many different factors, and your insurance company can break those down for you if you want. But truly, your monthly insurance payment really can fall in between like $125 up to about $200 a month. That's the common range there for calculating your homeowner's insurance added to your monthly mortgage payment. So a couple of these factors, in case you're curious: good credit, claim history, insurance score, the price range of your home, of course, and how far it is from a fire department, which is actually pretty important. You'd be surprised to know that homes like in the Elizabethtown area are actually cheaper to insure than homes in, per se, Battletown. It could depend on if you're bundling your home and auto. They can give you like a 20% discount if you're adding your cars to the policy. Vinyl siding is more expensive to insure than brick. The age of your roof and HVAC, all of this stuff comes into play. So $2,400 a year is really about the higher end of what you're going to pay for a homeowner's insurance policy, which is going to break down to, of course, about $200 a month. That's going to be your higher end homes, or of course something way out in the country and maybe someone with a not so good credit score. So it can depend on many different factors. So when we're writing offers on a house and we're calculating what your estimated house payment is going to be, those are the 3 things that we take into consideration. Your monthly payment based on what kind of loan you're using, money down, your interest rate, of course, and then of course what your taxes will be and what your insurance would be estimated at. Okay, so let's look at some examples of what your house payment could be at a 6% interest rate. So for a $200,000 house, let's use the example of it being in county limits, 30-year mortgage at 6%, your house payment is going to be $1199.10 a month. For example, in Warren County, if we take that 8005 rate and multiply it by the $200,000 house you're buying, it comes out to be $1601 a year, which divided by 12, you're going to be looking at $133.42 a month. So we're adding that to your monthly payment. And then of course, in this range, let's say for example, your homeowner's insurance is about $150 a month. Your total house payment will be $1,482.52. Moving on to $300,000. If you're purchasing a house that's $300,000 in county limits, again, 30 years, 6%. Now we're not talking you've put any money down or anything yet. $1,798.65. Your taxes are going to be $200.13, and we'll calculate $175 for your insurance, which gives us a total of $2,173.78 for your house payment. Moving on to $400,000. Same scenario here. House payment of $2,398.20, $266.84 for taxes, $200 for insurance gives us a total of $2865.04. And let's top it off with the $500,000 price point mark. 30 years, 6%, your house payment would be $2997.75. Taxes will be $333.54, and we're still going to figure that $200 homeowner's insurance mark, which gives us a total of $3531.29. Now, let's look at what this would be if rates went back down to 4.5%, okay? There's a difference. In that same $500,000 house, instead of your payment being $2997, it's going to be $2533. Your taxes and insurance would remain the same, but giving you a total of $3,066.97. So just that interest rate change alone dropped your house payment from 6% to 4.5%, nearly $500 a month. That's a huge chunk of change. It's a car payment or 2 weeks of groceries. What would the difference be between the percentage rates on that $200,000 house we talked about? Instead of a house payment being $1199, your house payment at 4.5% would be $1013.37. And with tax and insurance, the difference there gives you a difference of $1296 instead of that $1482 house payment, which is a difference of about $185 a month. So yeah, as you can see, interest rate matters. We all look at what we can afford. Most of us look at it based on how much does it cost me monthly? What are my monthly payments going to be? And that's how we kind of gauge whether or not we can afford a home or not. Don't we? We all do it. Same with our cars and our toys, our boats and RVs. What's the monthly payment? What can I afford? And this interest rate hike is definitely affecting what some people think they can afford. Now, of course, these are all estimates in a case-by-case basis. This is just a very basic breakdown of what it can look like and how they differentiate. Can you still purchase when rates are this high? Absolutely, yes. You might just have to change some of your criteria. Maybe you can't afford that $500 price point, but you can drop it down to $450. We don't know. Only you know what your income looks like and what your lender is telling you you're approved for. So it might come down to you unchecking some of your boxes on what you want to find in a home, which is okay. And as they say, you marry the house and not the rate. So interest rates can and will change, and we can refinance if possible. You will have options, and your interest rate can fluctuate after you're already in the home. And of course, that's what we saw happening all over the place in 2020 and 2021, because people who chose not to move, lots of them refinanced for this reason. And what's really great about it is there are still beautiful brand new homes within that like $300,000 to $400,000 price range. You can get a brand new home still in that lower 300 range right here in Bowling Green. If you want to check out some of our neighborhood tours, two that come to mind is a neighborhood called Carter Crossings and McClellan Crossings. They're ranging in that 300 to 400 range, and they're brand new. So even taking some things off our checklist isn't necessarily a bad thing when we're still able in these counties and in our state, we're still able to purchase a brand new home. The moral of the story is don't be afraid of these interest rates. You're going to be afraid if you're looking at your highest price point, top of the budget, and freaking yourself out a little bit. But if you take a step back, and if you're in the market for purchasing a house currently, you don't have to purchase at the top end. You can still get a very nice house in what you can afford, even when rates are higher. It's all going to depend on your case-by-case personal situation. And of course, we can refer you to a great local lender who can break down all of these things for you. Can you still sell your home in a market like this where interest rates are higher and buyers are kind of on pause a little bit? Absolutely yes. Again, this is all on a case-by-case basis because maybe you've been in your home for 15, 20 years and you've remodeled and done a tremendous amount of updates. That's going to increase your value significantly. Of course, it'll depend on how much you owe and what your home is worth. We might have to sit on the market a little bit longer. Houses aren't selling in 5 minutes like they were in 2020, but they might sell anywhere from 5 days to 5 weeks, or even if it's a couple months. We're now being faced with a more normalized market and a slower pace, which is perfectly okay. So if you're not sure what your home is worth, don't hesitate to reach out. Jarrett and I work as a team. He's also a certified residential appraiser. This is what he does. And I've been married to him for 21 years. I've also been a report writer for some of his appraisers, done the reconciliation work and the adjustments on the back end. I understand what's on that appraisal form and how they come to that number. So Jarrett and I together, we are fully capable of pricing your house correctly in the market that's current and right on track with what's happening. A common question we get asked is, can you do an appraisal on a home you're listing? Absolutely not. It's conflict of interest. We do not do that on that purchase. And if you're curious as to what types of things increase your value, reach out to us. We love having these conversations because we get asked all the time. If you're curious if you added a shed or you've replaced your countertops, let's talk about it. Because typically you'd be surprised on what is just money spent and out the door and what will actually increase your actual value. So reach out. We'd be glad to answer your questions. We have faith that rates are going to go back down and things are going to even out just like they always do. Real estate is up, it's down, it's all around, it's a chaotic mess. Feel free to reach out to us. Our information is below. Thank you guys so much for watching. Hope this video was helpful. Have a good day. What happens if you're paying cash? That's easy. What interest rate? This video is irrelevant. We can all go home now. That's the goal for us all, isn't it? Guess we better start a YouTube channel and make it go viral.